Brazil operator, and I was a union meeting about 500 employees.
Yes.
And I had to go and stand like this and tell them that half of them are going to be fired. That was not a story. And then answer any question. So I hope this one will be better. Yeah. Just figure it out. What's that?
Yeah.
Sorry. Okay, so I hope you all had a nice lunch and feeling refreshed for my presentation. My name is Matej Reisman. Just a second. As it says here, just to give you a little bit of background, I've been active in the financial industry for the last 22 years now. I started to work in 2001, and at the beginning of my career, I actually worked in, or my company still does that, mergers and acquisitions. I also still manage a fund that very much focuses on investing on non-traded companies. I do a lot of trading based on with the help of technical analysis. Also establishing a hedge fund at the moment that is going to do that for institutions and high net worth individuals. At the moment, our company is just about to enter into cooperation with Inter Capital from Zagreb to be the client agent in the area of offering services to high net worth individuals in Slovenia and to advise them how to manage their wealth. And lastly, our company is just starting to manage 35 billion for wealthy individuals from Slovenia. Who established a trust fund for their children, and we are advising them on managing this both by trading actively as well as doing long-term investments. I think that for everyone coming from this region, we know the history of the region, and we know that the state of our economies and the business environment. So what I'll try to do is to tell you my journey with the professional designations, and then how I see the application of technical analysis to our local stock exchanges. So first, because we listen to the other speakers, I'm going to go through a very short definition of what is technical analysis, what is the F analysis, as Henry would say, or the fundamental analysis, then quantitative analysis, and what and how risk management ties into all three of them. And I'll also give my view on each of them. So basically, first of all, coming to the definition of technical analysis. So basically, I have three definitions here. In general, what they say is that in technical analysis, we try to predict what is going to happen in the future by looking at price, volume, and open interest. As said, and he said, I also find it very important the 3 points that are made under the definition, which is market actually solves everything. And that's what I said before. You know, people make sort of a technical analysis in their daily life all the time. They try to make decisions on what to buy and at what price. I'll give you an example where you go and try to buy a new car. You go and you compare the prices online. You start thinking where you could buy cheaper. You may go to an auction even and participate in the auction. And consequently, you participate in an organized market, meaning that other people are bidding for the same thing as well and trying to buy it as cheaply as possible or get as good a deal as possible. And often during those processes, we get carried away. For example, we really like the model of the car. There is a lot of people bidding, so we'll just get into the heat of the moment and try to give a higher and higher price, and then ultimately we'll end up buying it at a very high price. And the next month we'll see an advert on internet that will advertise the same car for 20-30% lower, and we'll be unhappy. Also, a good example of what we do and what our psychology, what we are driven to do, is when we just a lot more people buy shares that people that use technical analysis, and or we put money into mutual funds as an example. What is really interesting is if you look at the charts of the payments into the mutual funds, it shows you that when the market is at the bottom, there is the highest withdrawal of funds from money from the funds, and when it's at the top, there is the biggest inflow of money to the funds. I don't know for what reason. It's probably because we have like animal spirits, or if you will call it like that. We have the inbred genetical code to act in a certain manner, and according to principle, we saved our lives when we were still living in caves. We tend to behave in the same patterns, and for example, the pattern of following the crowd, of trying to make sense of things that do not necessarily make sense. All of those things are used in our decision making, and we can see them in the financial markets. What technical analysis teaches us, and to me, it was a revelation, because I was a big user of fundamental analysis, trying to always convince the right thing is to look at the value and then the price will follow. Why would it follow? You know, if other people think that the price is different, it will not follow. And it was such a revelation when I went into technical analysis, because always it gives you sort of the first data that is there to analyze. You don't have to look for background data. You don't have to go much deeper than just looking at the data that's there. That's the price that's available on the screen. My presentation can be shared with everyone if you want it. So I will not go through the other 3 definitions. What I don't necessarily agree with is that the technical analysis is chart-free. Charts are a very nice tool to visualize data and to help us to process that data with our brain. But I would say that actually technical analysis is anything that analyzes the price and the volume and the open interest, and try to make predictions on that. So if I come to fundamental analysis, probably a lot more of you are familiar with technical analysis, but it basically looks at financial statements in the case of companies. It looks at economic data, unemployment data, all sorts of fundamental data about what's going on around us. The problem with that data is that as soon as you have looked at it, it is outdated, and normally so by a few months, at least, or a month. For example, when somebody prepares the balance sheet and the profit and loss statement, that doesn't tell us whether there's enough orders in the factory right now. It doesn't tell us whether a competitor has made a discovery that makes the product the company is making obsolete. So basically, by trying to predict the future based on that historical data, can lead to big mistakes. What I would say is that it gives people comfort, and it is anything that's systematic, anything that makes you analyze things in more depth than your competitor or somebody else is useful. I'm not saying that something's not useful, and still, if people would agree on the future of a company, then, as David has pointed out, then we wouldn't need any markets, because everyone would say the price of this bond is 100, the price of the company is 5 million or 100 million, and everyone would say that's the price. If you want to buy it, you pay that price. But because the future is uncertain, people do not agree, and the market is the judge of what the cumulative expectations of all the people are. What I would also say is that when people say, "Oh, this is really undervalued because it trades at 20 times, not 20, 15 times earnings, and it's going to grow earnings a lot," I'm saying, "Okay, but what if the earnings fall by half? That's like 30 times earnings." So basically, in other words, you will only get it back if you pay yourself all the profit within 30 years. So to me, what is interesting is that the closer you come to something being very, very cheap, the more people agree that it's cheap. But when the price starts to rise, then the difference in opinion is huge. We mentioned Warren Buffett before, and basically, when he started, stocks were so cheap that you could buy some stocks for the price of cash in the balance sheet. The stock didn't have any debt whatsoever, and because people were panic selling, you could buy $1 for 80 cents. To me, that's cheap. Anything else starts being a matter of opinion. So basically, what we said before, there's different groups of people. For example, the stock exchange, there's the really long-term investors, there's the people that just trade for one day, there's the people that trade for 1 hour, for 1 minute, for a few seconds. Then there's people that have a huge amount of money and need to place it there. There's people that can wait. There's the employees of the company, there's the CEO of the company, it's their family. So all those people have different information. They have different, probably different educational backgrounds. They have different institutional settings, and we cannot know who those people are because basically there's so many of them. So basically, assuming that we know what somebody is thinking is wrong, and they probably have enough information. I was told at a very young age by my dad, I should never assume that somebody else is stupid. And when you are investing in the stock exchange, you should think that all the other people are smarter than you, and that you have to therefore look at the price and see what it's doing. Then coming to quantitative analysis, because this is the buzzword. I just was discussing AI before, and we are going to have a panel after. Like when somebody says, "I'm a quant," I expect at the moment, because it's such a bad word, but that everyone will bend to their knees and say, "Great, we know the universe, we are going to make stellar returns, and there's nothing better." Basically, to me, quantitative analysis and investing is just a tool that can either be applied to fundamental analysis or technical analysis or any type of data. As I said before, and what is really important is that the technical analysis looks at price and tries to predict what's going to happen in the future. And by using the quantitative approach, we are just being very systematic about it, because our minds have the wonderful ability that we can process really difficult information really quickly. We can summarize it in understandable charts, or we can recognize patterns. Sometimes it also plays tricks on us because we see patterns that are not there. For example, we talked about the head and shoulders pattern. You know, sometimes there is a pattern, but if you ask 5 people, some will say there is, some will say there is not. So the difference of opinion and what we see in data is a lot different. With quantitative analysis, I think mathematics and statistics always offers a very good tool to make sense of data and seeing whether there is any relationships that hold through. Also, just before we mentioned the Dow theory, which is basically was developed 120 years ago and is still used today. I use it myself to look at the longer term trend, direction of the trend. What it does is it looks at how the price of the Dow Jones, which is the industrial sector in the US, is behaving, and how the transport sector of the Dow Jones is behaving. Because the logic behind it is that production or the industrial sector, the transport sectors are really interrelated. So how they move, whether they move in unison or not, is really important for predicting whether it's a positive or negative trend. But why I'm mentioning it together with quantitative analysis, because there I saw for the first time that people are specifically measuring how long a bull market is lasting. You know, what the definition of a bull market is. Is a bull market when the market rises by 60% or 20% or 10%? Is it, or what is it? And basically, what the chances are that if something has risen for half a year, let's say, and to a certain level, that it will continue to grow for the other half a year. So what I'm always trying to do myself is to think through the project by myself, going back to the basics and saying, okay, what is the data? What is the problem? Is it being done right? How is it being done? And that really helps me to get out of the essence of the problem. And I think that why I'm mentioning this is because in all of the markets that we work in, we have particularities. So it's really, really important that we look at the data and we make sense of it by ourselves, because sometimes the standard tools that work in the more developed markets that have really much higher liquidity, that have more sophisticated players, simply don't work for us. Basically, then going to the risk management part, I put this in because within the qualifications, we've got the qualifications focus on the fundamental analysis. We have the qualifications focus on the technical analysis. Then some qualifications that allow us to better do quantitative research. But with everything, basically what we want to do is we want to make as much profit with every risk factors. So the risk management, it becomes important as well. And basically, I think that further in the knowledge in all those areas can help any organization that is engaged in investing, trading, or just hedging their product, on having to rely on buying and selling. What I also wanted to say is that personally, I don't like the distinction between investing and trading. To me, they're both the same. It's basically you want to buy something and make money out of it. It just depends on the time frame. So saying, oh, this guy is an investor, and he does the right thing because he buys this company and holds it for 30 years, and that's such a good thing. He's supporting the economy or whatnot. Is to me is completely the wrong look at things, because somebody who buys the share and sells it 3 days on for 2% profit, he's also serving a purpose in the market. He's making the market more better. He's making it more transparent. He's basically adding to the efficiency, to the fairness of the financial system. Not necessarily the fairness, because all our systems are based towards the smart and the strong winning, and some people losing at the same time. But basically, risk management involves the identification, analysis, and acceptance or mitigation of uncertainty in investment decisions, and it's really inseparable from research. I've seen so many people that say, that think, oh, I'm the biggest king because I've made 10 million euros in the last 10 years. I'm so smart because I identified this company in, I will not name the country, but one of our countries. And I just, because I drive really good Mercedes, I'm smarter than anyone, and everyone is to bow down to me. It's actually one of my favorite quotes is that often people mistake luck for skill. It's basically when you are lucky and you win, we tend to think that we are always going to win. In management, this is called the hoovers, which means that when people are managers and their company starts making tens of million euros of profit, they think that again, that they are invincible and that they can do anything and will get away with it, and that nothing can happen. So basically, now coming to the professional designations. Oh, here's another one which I wanted to show before the professional designation. This is a really long-term chart of the S&P index from 1979, when I was born, coincidentally. Didn't choose that, in just a chance. But anyway, it's until September 2023. So basically, it's now 44, almost 44. It's 43-year and 9-month history of the real logarithmic returns. So basically, that means that the inflation has been subtracted from this. Why I wanted to show this is we all say in general the stock markets have a positive tendency. So basically, if you buy a share in 1979 and wait to today, or all the shares for the S&P index, you would have made 5.2% return over inflation. From 2000 to 2022, that percentage would be 2.5, but it would still be in a plus. But now, why is technical analysis important, and why is using technical analysis for risk management really important? If you look at the drawdown after 2008, plus forensics, it was 50%. So if you actually got 10 million euros and put that into the market in 2007, you would have only had 5 million euros, and it would have hurt tremendously. Also, if you put the money at the peak of the bubble in 2000, you would have had to wait almost to the end of 2006 to get it back, and then you would lose half of it again, and would have to wait, I think, until 2013 to get it back. And so basically, saying over the long run, you will always make a profit, but a lot of the financial advisors are saying just throw the money into the market, and it will grow. I tend to agree a little bit if you are putting a very small amount of money into the market every month, because then you will buy at all those prices. Yeah, but if you are a fund manager that gets 10 million euros and you have to invest it now, or you have to buy 5 million euros of crude oil. That doesn't apply because you have to make one decision, and that decision means whether you hold at the peak there, or whether you hold at the bottom there, or somewhere else in the curve. So it's really important to time the market, and it's doable. At the same time, your goal should be to not do those 49%, not do those 23.5%, or the 12% on the top, but to try to reduce the drawdowns in accordance with your risk parameters and to earn to be better than the market. We also touched on the points I made here. In today's world, it's really easy to get information. You put a question to ChatGPT, you Google things, you go to YouTube, and there's a lot of videos. But the problem to me is that it's very, very hard to distinguish the good from the bad in this flood of information. What I would say is that the association we formed is the right place to go, as we mentioned before, as are the other associations, because the association societies make sure that the right information is gathered at the right place, and also the people that are members of those organizations are really experienced and have gone through a lot of situations and have sort of filtered out through their careers, mentors, previous mentors, and trial and error what the good is and what the bad is. Now, the professional designations allow employees to continuously update their know-how from the best sources, to really expose to international experts and to study the subject holistically. Like personally, if I haven't done the CFA and I did the CFA and the CMT, which is the American, which is the IFTA designation, and the designation for technical analysis from the American organization, and they helped me to sort of learn about everything. If I study by myself, I just pick little pieces of information, and it's too easy to say, "Oh, I watch Netflix instead of studying about technical analysis, or I'll go out for a beer." But when I have exams, I actually study to pass that exam, so it forces me in a way to really have a look. I would also compare investing and trading, although I think they are the same, to sports. I like to use the comparison of boxing. There's a lot of evening boxers out there that think that they can beat up anyone when they drink 5 beers. And some of them can, because they are really challenging and huge. But anyone who practices boxing from an early age, even though they are 70 kilos, will probably down a person that's 120 kilos. Because they are really fast, they have technique, and they don't make mistakes. So the same with football. I played football with a friend who was a professional football player on a small field, and there was all of us. It was just like he was just like playing with like poles standing there. We just had zero chance. The same ski jumping. I mean, if you went and ski jumped in Planica in Slovenia, where they jumped for 200 meters, really crazy. I think you will be sure to die. The same in the stock market, but the difference is that everyone thinks they are good investors without really learning from the best sources and practicing. And the professional designations to me are similar in practicing the sport for many years. The same can be done if you are in the market for 10 years in a good institution. Have mentors that teach you and learn from mistakes. Start small and build big, so that you will also learn from your mistake. I wouldn't say, though, here that having the professional designations absolves you from really making the mistakes. Nobody can learn in the stock market without losing, at least I personally lost quite a bit of money before I learned this. And I think it's the same for anyone. And anyone who says, I've never lost money, I never felt the pain, he's just lying, or she. So now, coming into the professional designations, I obviously put the best and the most important ones on the top. I just put them like this because I think that technical analysis is really important. But CFP is the Certified Financial Technician. It's a really, really good program. And anyone interested in technical analysis, I would recommend it to. It has 2 levels, and really you learn everything about the indicators, oscillators, about the different techniques, all of the techniques that were presented today, about setting stop losses, how to set targets. Basically, it teaches one person or somebody on the internet set that also have the CFA and the CFD. CFE, that basically the CFA teaches you how to get the job, and the technical analysis, the designations teach you how to keep the job. It's basically, when somebody says to you, now buy this thing and make money, or if you are like a foreign exchange trader and they tell you, they don't tell you that, but they should. For example, you have to save so and so much money each year. If you don't know technical analysis, you are going to find it very hard. But if you know it, then with every trade, you will be able to add value. Basically, you will look at the price and say, "Oh, maybe I should wait for a few hours. Maybe I should buy it tomorrow." You will know how to act, how to execute the trade, and how to think about the market. Now, the MFPA, the Master of Financial Technical Analysis, is at the moment the highest designation you can get in technical analysis. And basically, correct me if I'm wrong, but you need to be a CFE or CMT from the American Association, or you need to have a lot of experience. And in addition to that, you have to write original piece of research on the subject of technical analysis that adds to the body of knowledge of technical analysis. So basically, you need to really have a deep think about the area of technical analysis you want to cover. The CMT is the Chartered Market Technician. It's from another association. They, as I was told, they used to be both together, or they used to cooperate a lot closer. But then, people are people. So 25 or something years ago, they split because the Americans wanted to do their own thing. Everyone else didn't want to be bossed around by the Americans. So in a lot of countries, there's CFA, and in some countries, there's the American organization. But they both offer high quality. They teach high quality technical analysis the way it should be taught. Personally, I would say that what I learned is that that it's the best is to learn from original sources, because with every single recycling of the data, something gets lost, because the people that actually develop the concepts have really thought deeply about them. And when we said before that today with computers, information is like too quick at our hands. Before, if you wanted to explore something and test something, you had to put so much effort to record it on little pieces of paper. So people were putting much more thought into everything they did. And I'm not saying that today people don't exist that do it, but it's, in my opinion, a lot of the best work in technical and fundamental analysis came to be when with the computers were still at an early stage or even before. We just showed you that that people sometimes need less to be better than they need more. Now coming to the CFA, Chartered Financial Analyst designation. I think it's also a great designation because it gives you a wide perspective. Also, the CFA has recently added a little bit of technical analysis in their teachings. But in general, what the CFA does, it teaches you how not to make mistakes. It teaches you to look at the different organizations and do the strategy according to the needs of the organization. So basically, if you are an insurance company and have a horizon of 20 years, or you have a horizon of 5 years with a different product, the CFA will tell you what to do. Also with the personal finance, it will tell you how to think about each the person's need and how to do that, and a lot of accounting data, a lot of valuation data, and whatnot. So definitely the CFA and the CMT, CFP, the technical analysis designation combinations, I think are really desired. If I was the director of a trading desk of a department in a bank or an asset manager, I would really encourage as many of my employees to have those designations, because it proves that they are hardworking, and it proves to me that my organization will be getting better and better. The FRM, the financial risk manager, focuses a lot on risk, on the different measures of risk, on the processes, and how to implement this in the organization to be again better from the perspective of controlling what's the downside. Then coming to the CQF, this is the certificate in quantitative finance. It's actually a designation I'm doing at the moment. I'm 43 and going to be 44 in October, and but I only discovered in like 4 years ago that I really like studying. I was young, I was mostly drinking and chasing university. But basically, now I discovered that actually sitting down and learning new stuff in the structure really calms me down. Why I went for the certificate in quantitative finance is because I strongly believe that the technical analysis can benefit a lot from artificial intelligence, from machine learning, and being even more structured, to having a fixed set of rules that you can program, to having the real mathematical approach to analyzing the market. And lastly, I wanted to show to the quant people, which are a lot of them are mathematicians and physics majors, mechanical engineering, and degrees like that, that they're actually using technical analysis, and they look at the models, but because they don't understand it enough, they misuse it, and then they think it doesn't work. What is interesting is a quantitative approach can actually also be used with fundamental data, which is called I forgot what it's called, but something with fundamentals. But basically, what they do is they sift through large amounts of balance sheets and P&Ls and try to filter through the companies and see which ones will be good and try to predict what will happen in the future. They also look through economic data. They look through the different patterns. One interesting story which my friend Trevor Lee likes to share is that people always think that funds are looking at the parking slots in front of Chinese retail stores, and based on that predict what the stock price is going to be of the retailers in China. I really think that false. I think that looking at this just tells you that the Chinese at the moment are not in the stores or whatever. You know, I think that there is not such a clear link nowadays between having some sort of satellite and looking at people moving and then predicting from that. I think that we as people often think that we can explain the linkages. and based on some indicators that are only available to us. Although there's probably 100 people looking at them at the same time, that we are going to build. That it's just my thoughts and my opinion that that's why looking at the price is actually really the best idea, because the price is changing by the second, and it's subjective. It doesn't lie. So coming to the end, just over the naming of the different designations, I would say there's other ones which are also I would recommend within organizations. They are accounting and audit based. Like certified auditors, certified internal auditors. They are all helpful and make people better professionals. Also, there are designations for alternative assets, such as the chartered alternative asset analysts and personal finance planners. Maybe in a different region, it would be so important to go through all of this. But in our region, I think that just looking at the people who sell investments, that they have, they are former, hairdressers, nothing against hairdressers, but with a 3-year school and cutting your hair, I don't think that the people are the best suited to sell me my retirement plan. Because I think that it should be analyzed closely. I should really understand what's going on, and they shouldn't sell me the wrong products. So I think in all areas of the financial profession, I think that the whole region should take an approach of going more formal and to give people better education and to demand better education.
What if the hairdresser is the Warren Buffett hairdresser?
Yeah. Yeah. It can be. Yeah.
Then you should consider.
I was working for a really rich owner of retail stores, and because he never finished school but made hundreds of millions, he thought that everyone's like that. So I was getting so angry with him because his whole purchasing department were people without any schools, and I said, like, we are not in that age anymore. You should actually mitigate the risk by hiring people that have good grades, finished university, and proven if they have something in their heads, so that they can make a strategy of how best to optimize the different good categories and provide them to save money. So basically, I think having the formal education behind you just gives the employer a better chance of judging whether you are diligent and capable of doing this. So now to the question whether the technical analysis can be applied to the stock exchanges in the region. And I had a long thought about this and went and thought which premises or assumptions of technical analysis would work in any market, even if the liquidity is not very good. And to me, they are that if a trend continues, it is more likely to continue than to reverse. Because if, for example, people see that everyone is mad watching a film, like going crazy watching a film like art in the cinemas, they go and want to watch it as well. And I think that in the stock market, that also happens. When people see that people like something, they will go and like it as well. The second one, I think, is how trends end. How does something end? It can either fizzle out, there's an actor which is really popular, and then he doesn't do a good film anymore. So we start to forget about him, and then after half a year, it fizzled out. Nobody can remember his name, and we forget about him, or a position. Or a climax, that's like, I don't know what the name was of the people that died when they are 27. They just go and are really popular, and then they drink and they pull over or take drugs and die. I think that with shares, that's just analogy. But what happens in the stock market is that something is really popular, everyone wants to buy it. So everyone buys it and it just explodes. Then when everyone has bought it, like there's nobody left. They just look at each other and then it starts falling because nobody has the money to buy it anymore or doesn't want to. The same happened with pyramid. It's like a pyramid scheme. You know, in the rich we had quite a lot of this. So people came and said, "You just get me 4 people," and they invested. They put in the money as well, and they get 4 more people, and each gets 4 more people. So basically, what happened? People didn't realize very quickly when you do this game, there are no more people that will actually participate in the pyramid scheme. The third one, I think, which is really important to understand, is that what is happening is that the price has a range. So basically, if something is between $100 and $200, you know, that's $100 range. And then what happens in markets, because people start to sort of agree on what they are willing to pay, is that this goes together. So suddenly the range is only 10, and this acts as sort of like pushing it together. So when it's pushed together enough, it explodes together. And this happens all the time in markets. So I think it's a really important question that people build up tension. You know, nobody wants to let go, and once they reach the breaking point, it goes and blows up again. And then the fourth one, which I think is also really important, as Trevor said before. For example, if the price 2000 is something that people remember easily, and it trades to that level 5 times, that price is a lot more important than the 1705 price. That went where the price was shot through it. And so we always look for repeating prices, because if a lot of people are willing to pay that price or to sell at that price must be important. Then the fifth one is what we said before, that the price levels that we identify in a longer time frame also hold in the shorter time frame. So basically, if you look at the monthly chart, and you see that on the monthly chart, there's a zone where the price can go through. When you lower it to the daily or the weekly one, you also have to, the price also is important, because you also will break through it. So you can look at and identify things, trends on different time frames, and then when you go to another time frame, it still holds true. And the last one, which we also mentioned, and I don't know who it was, or maybe several of my predecessors, the people who spoke before me, that is the momentum perceived price. The momentum is if we have a price of 100 and then it moves to 110. The momentum is 10. So basically, it's the speed. It's basically how fast the price changes. And it's really important, because on the top, for example, the price doesn't move so fast anymore. And once it doesn't move so fast anymore, it's an indication that it's likely to reverse. And I think that this principles here work whenever there is a price. It doesn't matter if it's not a completely developed market, if sometimes there's no liquidity. When people start to get feelings for investing money, these things will happen. Now, the problems that we are facing in the stock exchanges here, there's relatively low volume. There's short selling is not allowed. There's weak legal protection shareholders, meaning that so-called tycoons or the big shareholders can just make you lose money, or they don't pay a fair price. They buy the company through 10 different companies, don't make a takeover, and things like that. And there's a small number of large institutional players. Then there's, if we go back to the fundamentals, there is a relatively low valuations and higher dividend yields than in the developed market. So basically, even though the market is not so active trading, you still get a 10% dividend here, which is quite a nice dividend yield. It has nothing to do with technical analysis or trading, but it's just the fact that because there is not a lot of trading, things are cheaper. If you believe that the value of the thing is higher than what is being shown on the stock exchange. But on the positive, we all have growing economies. So that should add to sort of like a positive feeling and a positive flow. Now, to analyze, before I go to some stock charts, and I chose the stock of Sava because they are the sponsor of this event, and the stock of Alkaloid because it's a Macedonian company. And for both, I think that technical analysis is very useful. And if it's useful for those two companies, then I think definitely anyone who deals with currencies or any other type of commodity should use technical analysis, because people would agree that the Macedonian and the Slovene stock exchanges are not the most developed and the most active ones. This is a monthly. On purpose, I have not put on any lines. I have not used any other indicators, but the MACD, that we were seeing before, without tweaking what is in the actual software. Personally, I normally use slightly altered indicators, and manually I use slightly different one that I will not explain now. But it's the most important thing is that as it was mentioned before, all the indicators that show a certain condition of the market will give you the same picture. Some will be faster in one environment, some will be faster in another one. One will be a little bit more reliable, the other one will give some false breaks. But the most important thing is to always get the logic right. To always know how to think about the market. And that's why I wanted to give you, let's say, quite a blank chart and to just talk to you about what I'm looking at when I start to analyze any chart. And as we saw before, what is really important is sort of the price levels where the price was at previous times. So you always start reading the chart from the right to the left. And if you look at the monthly chart, what happens to the Sava share, from let's say 2013, where the shares really started to grow after the 2008 crisis, it went into a really nice uptrend. Again, this is, if you look at the MACD line, it's not visible so well, but the blue line, it went above the signal lines. Basically, what you do with these moving averages that we were mentioning before, you just take the price of the preceding days or months, and you do the average of that. Because what that does is it smooths out any wild jumps. And by having the average of it, you get like a much slower moving chart than if you look at the actual candles in each of the periods. And then again, what we were talking before, the chart went into the trend slowed. It went into sort of like a ranging motion, and then basically, if somebody looked at that, it would say, okay, it's maybe growing slightly, but not by so much. At the same time, with this up and down motion, it actually was in an uptrend because it went up by another like 20% until 2020. So why would you analyze it? I always get angry in the region where people say to me, I don't believe in, like I spoke to some asset managers, I spoke to some financial professionals, and they tell me, and I told them what I do, and they said, I don't believe in technical analysis. So I'm like, what don't you believe in? Well, it's like, you probably don't even know what technical analysis is. It's simply analyzing the price. It's no reading of cards. You know, you have the info that's easiest available to you, and you say you don't believe it. So okay, you don't believe that when somebody wants to pay for the share, what else are you going to believe? So basically, if we look at this, we see that sort of this 15, around 15 euro per share was it always sort of like quite important. This price level was touched a lot. What this means is that if in the future there's going to be, let's say, a recession in the US, a global panic because of something, I can guarantee you that the price is, from where it is now, going to really fast fall to the 15 euro. Because in the past, people agreed that this is like a level that it's really important, that it's always going on. Also, what is then interesting is what was happening, after the Corona crisis. If you see what happened in March, then like entire market. What I would also say for our regions and our stock markets, they are correlated with the global financial markets. So by analyzing the U.S. market, the DAX, the European stock indices, and what they are doing, you can pretty much know what our markets are going to do with a lag of 1 to 2 years. And in the case of panic, this is in terms of growth. In terms of panic, they mirror it almost exactly. So when it goes down, we are really correlating with them, but when it goes up, we wait because we are not sure. And then 1 year after, our markets start to grow. So basically, what happened is that the price fell really fast during the March Corona. So basically, always when there's a huge jump in price, up or down, the prices have the tendency to retrace part of the difference. Simple reason being that, again, humans, when we see that something shot up really fast, it's a little bit of a shock to us. So how do we deal with shock? We say, oh, this is really cheap now. Hold on a minute. We start buying. Or something goes really fast up, and it might be still cheap, but it went up really fast. So we say, maybe I should sell at least some of the shares and to go out because, and everyone thinks that, so they sell and the price retraces. And so basically, whenever there's a quick fall, people should never go out, and it's evident in the stock markets in the region. Then, if you look again at the blue line from 2021, look what Patrick was saying before is, look, this line is flat and it's sort of very close to zero. So if you would have tried to use the MACD there with core, just kill me. So you wouldn't have used it there. But in the beginning of 2021, it just shot up. Like if you see this after the Corona. And there you would definitely go and buy it based on the MACD because it's a very good signal. And people think, okay, if it went up by this first candles, then often we say up, but it will not go up anymore. Sorry, you miss out opportunities. If you don't follow technical analysis and go by gut feel or something, or by fundamental analysis, this is clearly something you would buy and you would hold where it crossed the line again. And what would have happened? You would have sold right on the top. And so somebody should tell me that they are not using technical analysis again in one of the fund managers in the regional pension funds, and I would fire them immediately if I could. But I don't have the power. But somebody to say that is just ignorant. It's not. I'm not somebody. We are not a religion. Yeah, we are just professionals like everyone here, and we are. But you need to have an open mind to use the tools available. just stupid not to do something because you made up your mind that some crypto little guy that has 25 years and thinks that he's the king because he was lucky and bought something he had no understanding of and made some money. He's not a technical analyst. He's somebody that watches too much TV and plays games. You know? So basically, here, also when you do a fundamental analysis and you see that you like the share in terms of how much it's valued, what the future prospects is. The most logical thing is to see where the thing is in the technical perspective. If nothing else, it will show you whether it's a good time to enter now, or you should wait for a pullback in price. At the best instance is that it might make that that your analysis is wrong. Because as we said before, if something was in a downtrend for the last 2 years, although you made an analysis and think that it's so undervalued, such a high chance that you are wrong, that it's simply a shit company and it will continue to go down. So basically, you never buy against the trend in this sort of situation. So price again is something really, really important that allows you not to make a mistake. And the other thing is that, I've done fundamental analysis so many times before going into technical analysis, and I bought a share, and then I've seen it go down 30%, and I was like, and then people tell you buy more. It's just so stupid. It's better in the first place not to buy it, but wait that it falls at 30%. So also, how we can use in our markets is to have stop losses. You say, look, if the price will fall under the low we have here at the beginning of 2023, as an example, just under 20, then this thing is going to over 15. Whatever your time frame, why the heck would you be holding if it falls to that technical level? Simply local investment funds that just hold on for dear life. I don't get it. Why would you go when things would fall? And my back gets back to that level, for example. So then going to the next time frame, is the weekly time frame, which then becomes even more interesting because the monthly one, as the MACD was very long, there was not a lot of signals. We saw there was only 2 or 3 during the years because our markets tend to have long trends, and I will show that with alcohol.
You are 10 minutes.
20 minutes over, or less.
Over.
So then, okay, so I'll go quickly. So here you also have the line is under the green line, so it's clear you wouldn't be long there. You have many more possibilities to enter. So basically, the technical analysis works. It works really well. So that's in short. And this is then just the big one. That it starts to be a little bit choppy, which is not good for technical analysis. You see this little points almost not trading on certain days. So what I'm saying is on our markets, if you have the feeling it doesn't work, you just increase the time frame and then it will work. Now coming to argument, this is here I go to the reverse. This is the daily one. This is even more choppy, so it's not useful for the daily one. I will use it. But on the weekly one, it becomes useful again. Then we have a really nice trend there. Then you would be out because it's like sideways and really choppy. Then it's a downtrend, so you would be in, but you will go back in here. So it was growing, and now you could be in it. Although the movement is flat, it's probably going to go down. And then on the monthly one, then just to finish off the presentation, it's a really positive long-term trend because there's more demand than supply. So, you know, you have some instances where you want to be careful and maybe go out of the market for a little bit of time, but in general, the direction was always up, and now it really turned. So now you have to be careful otherwise because although it's still ticking around and growing, I'm guaranteeing you that there's going to be the next market correction. It is going to drop. Yeah. So that's the version that I hope you.